today you are here because I only gonna cover grocery store tax planning. There's a couple of things really important to mention. So we only have 30 minutes and we will dive into it right away. Okay, so let's get going. And I will share screen with you to my screen number 1. And I will use what I call the whiteboard today. It is a technology you're gonna love because I can draw to you what exactly you need to do as a grocery store, okay? And a tax planning a grocery store. So we have a grocery store and has sales for 1 million in 2020. PPP loan for 150,000 they got. And the EIDL loan, they got 200,000. Payroll expenses, 300,000. Cost of goods sold, 400. Other expenses, 350. Then we have minus, not $50, $50,000 loss in there. So now I want to go to our whiteboard and we are going to play with our numbers. I want you to kind of know the number because I am switching screen. And I did print out my numbers. So I'm actually looking at my number so we can go to the screen to see what I can show you. So now I am going to share with you my whiteboard. And we use the whiteboard. We use our whiteboard to do not only webinars right here, and we also use our whiteboard to talk to our client and to bring client understanding with us, even though we don't meet in person, but we actually, can talk just like that. So here, I am going to draw because this is my ABC grocery store. So in this store, and I already mentioned to you that we made money, right? We had a sales of 1 million. This is my 2020. And now I also have cost of goods sold. Remember how much that was? That was cost of goods sold was 400,000. I actually did not take those numbers just like numbers. We know that is how grocery store runs, okay? So you make 400, you have a cost of goods sold at 40% of your total sales. That's very normal. Just depends how you get your groceries. But if you look at overall, the top is 40%, and there are grocery stores and running at about 20%, 20 to 30% is the majority. 40% is the highest, okay? So now we also said that, so right here, we have what we called gross profit. This gross profit item is very confusing because sometimes people think that, oh, profit. No, gross profit. Gross profit is before anything else happens. So you're really looking at your sales, and after you get all your cost of goods sold calculated, and this is what you have left for the period. And in this example, I want to teach you when you do tax planning, you need to consider PPP. PPP has two outcomes for you. You can get that forgiven, and you can turn that into a real loan. So now, let's just continue. Remember, I have this ABC grocery store. This is my example right here, right? So I said that we had annual sales of 1 million. Then we have a cost of goods sold. These you all understand. So we come up with a gross profit of 600,000. Right now, I'm explaining one thing very special for 2020. That is your PPP. And your PPP goes on two directions. You either got it forgiven or you become a real loan. Let me tell you, if it is forgiven, okay, then remember your PPP was used for paying salaries, right? So you have a wages expenses here. And in our example, I said the wages expenses was 300,000 total. That's what I said. If your PPP is forgiven and your PPP amount was 150,000, folks, I want you to remember you need to add that back. So PPP adding back. So when you add that back, your real salary expenses is what? Is 150,000. Not 300,000. So if you got forgiven, if you didn't get forgiven and it not become a real loan for you for whatever reason, maybe on December, because we're talking about at December 31st, 2020. If on December 31st, 2020, your PPP are still not approved, folks, I don't want you to do this. You need to scratch this out. You need, because you are not forgiven yet, you are a loan, okay? So you want to deduct your whole salary wages right here, the whole wages here, and you don't want to deduct, you don't want to reduce by 150,000 your PPP amount. You're only going to do that in the year your loan is forgiven. So that's your number one takeaway from today. Okay, so that's that one. Now you tell me that Ying, not only I got EID, not only I got PPP, I also received EIDL loan, 200,000. What do you do with that? That 200,000 may be paid your expenses, whatever you did with it. It doesn't show up to be taxable because EIDL is a loan. Loan means it is a liability and use not your income. Okay, so with that, we are good. So we take care of the EIDL loan, we take care of the PPP, and we know our salary expenses is 300,000. Our other expenses, and in our example, is 350. So that's the rent, the utility, whatever you are doing, right? So that gave us the profit. So we ended up with a loss of 50,000. That's what we were, our example goes. My year end up with 50,000 losses. Okay, this is your takeaway number 3. That EIDL loan is your takeaway number 2. Your takeaway number 3 is that if you have a loss, what do you do? Folks, in the past, when Trump was elected to be president back in 2018, and he did a tax changes called Job Act, okay? Its act is becoming the law. That was in 2018. It says that if you have a loss, sorry, you push that to the future to offset future gains. The $50,000 loss, remember I talked about Job Act, that was in 2018. And that was the Job Act. I call that Job Act. I think it's Jobs Act. It doesn't matter. And today, and in 2020, we have CARES Act. Okay, this act actually changed what's in the Job Act. How did they change it? They reversed it. They erased it. They're saying that the CARES Act says, okay, we are going to allow you to reverse this 50,000 and to the past. To the past, not the future. Not the future. To the past. How many years do they allow you to offset? They allow you to offset 2015, 2016, 2017, 2018, and then 19. 5 years. What does that mean? Okay, folks, if you had a loss in 2020, and any of these years, if you had a gain for 50,000, let's say in 2015, that year, my grocery store was doing great. I actually had a gain profit of 100,000. Now, the CARES Act allow you to go back to 2015 and to reverse that 100,000. So you only actually have $50,000 gain. The taxes you paid on here will come back to you. Come back to you today as a refund. Did everybody got me? Okay, so what I'm trying to say to you is, if you coming into December 31st, 2020, and you end up with a loss, but before you calculate that loss, I want to make sure that you understand, number one, PPP, number two, EIDL loan, and number three, you come to here. Because you may not have a loss if your PPP is forgiven. It is so important you do your accounting book right this year, okay? For grocery store, so important. And so now if you have a loss, then you know you have 5 years in the past to figure out whether you pay taxes or not. If you pay taxes, whatever you lost, that gain you pay taxes is a refund back. All right, so now I addressed something to you. PPP, that is your swinger. You don't know which way it goes. But on December 31st, if you didn't get a word from SBA to forgive you, that should not be taken into consideration. That is your liability. So you deduct what you need to deduct. Okay. And then EIDL loan should never even come into play. Even if EIDL loan paid for your expenses, that is still deductible. So you come up with your real income and a real profit or loss, and then you know what to do with losses. All right. So you may say to me that, well, Ying, the grocery store, actually, I did better. I did better in pandemic time. So 2020, I am not paying, I'm not having loss. I have a gain. Okay, let's talk about that. So I am going away from this screen, and I saved that into my folder. And in case you need it, you can ask for me. But right now, what I am doing is I'm restarting a sheet because I have another scenario to show you. Okay. And what if you say, I have a gain? So let's say this is your past. You have 2015, 2016, 2017, 2018, 2019, 2020. You can still see me, right? Let's say you had a gain. But 2019, you had a loss. And 2018, you had a loss. 2017, gain, gain, and a gain. The CARES Act said, if you have 2019, you have a loss. You, of course, can choose to offset this loss in 2020 gain. But you can also go back 5 years to get a refund back from these years. that you can go back to 2014, because for 2019, 5 years is all the way to 2014. Okay, so that's my number 4 things I want you to remember. You probably already filed your 2019 tax return, didn't even know that. Okay, that's okay. And you can still go back to get your refund. This is where the professional help will come in, and you just need to know you're right. You know, when you get audited, IRS always give you a pamphlet and to say that, do you know you're right? And you need to know you're right. Then you know how to work with the IRS. Then you know how to work with your tax professionals. Okay. So that is my number 4 give to you today. And you want to know that you're 2019. So now I'm going to cover you and another 3 things that's very important for grocery store. Okay. Now what I did so far is to give you the idea related to CARES Act, give you the situation where specific for 2020, because we don't have PPP in 2019. We also don't have EIDL loan in 2019. So those are all specific to 2020. But here comes things are not specific to 2020, but it's so important for grocery store to know. So I have a concept called a 3-dimensional tax planning techniques. And if you don't know what I'm talking about, go to my YouTube and you can find it in my YouTube videos, because I talk about 3D and in one of the session. Okay. And the 3-dimensional things, number 1 is what we call accounting method. Let me make it really, really simple for you. If you are a grocery store owner and your accounting method is cash method, you are at disadvantage. You didn't even know. Okay, so you are losing. You didn't even know. Why? So cash method basically means that if you paid for it, that's your expense. If you receive the cash, that's your income. Another method is called accrual. Accrual method means that if you know you are going to get it, if you have account receivable, the money is coming but not yet coming, you count that as income. But if you have account payable, the money you're supposed to pay but it hasn't paid yet, that you can account for expense. So in grocery store business, you normally don't have receivable unless you are doing wholesaling, right? If you're just dealing customers like Ying, I go to buy groceries, I pay you right there. I don't owe you money. So you, as a store owner, you don't have receivables in general. So whatever income you have is your income. Is actually by default, it's kind of like a cash method. You only get income when you get income, right? So of course, there's a credit card. The credit card, if your credit card is so bad, they deposit your money 2 days later, you have a receivable for 2 days. Okay, you can figure that out. Why are you dealing with a credit card like that? You should be looking at a credit card company who deposit your money right away. Okay, that's available out there. And so you shouldn't be having receivables when you are a grocery store unless you're doing wholesaling. But expense is different. When you buy things, sometimes you pay people right away, but sometimes you have 30 days, 50 days, 15 days, or even 60, 90 days because you are such a great grocery store, your supplier trusts you. Imagine that in December, you have a very busy time. And in December, your sales is up and you bought in December, on December 15, 2020, you're going to pay $50,000 to a vendor to buy your Christmas and the New Year supplies. And if this $50,000 is not cashed by your vendor, it really should not be on your book if you are cash method. But if your accrual method is already booked at the inventory you bought, so that become part of your cost of goods sold. So it's offsetting your income with proper spending that you are going to pay in the near future. This is why accounting method for grocery store should always be accrual. But how many of you are actually on accrual? I will tell you that I have not seen any of those small businesses who come over to our firm was choosing the right accounting method. And I will show you momentarily of where do you look for that? I know that is the next question you ask me. Well, how do I know? And I don't know. Everything is done by other people. I don't know. You should know. Okay. So I will show you that momentarily, but let me finish my 3 items that I really want to give you. So accounting method, number 1. Number 2, fiscal year. IRS understand business has seasons. So construction company, they don't really have anything to spend during the winter time. So that is from November all the way to the end of March. They normally don't have anything to do. Okay. And so grocery store, and the grocery store is more year round. A lot of grocery stores are actually just on the calendar year, just because they're year round busy. But there are also specialty grocery stores. For example, grocery stores only sell fresh produce. You only do fresh produce. You don't do anything in the winter. And it's like farm market kind of business. And then your summer is busy. And by the time you get into November and to March, if you don't do anything different, you don't have anything too much going on. When you are in the seasonal business, for example, I will start January and I go my month all the way. So let's say this is my June and this is my December and this is my January again, but this is my March. So let's just say that I am a grocery store who sells fresh produce only. So my only busy time is sometimes from May to October. Really, this is my really busy time. And then outside of that, I am really not busy. So from October on to March and April, I am not busy. A lot of sales. Most of the sales are here. So I want to end my year in April. You know why? So I want my beginning of the year is March of this time. So March 31st and all the way to, so I will start from, I will end at a March 31st because that's my, no, April, because we said April is our not busy time. So I'm going to end, let me just erase that. So I'm going to end on April 1st. Oh, so that's March 31st, right? Let's say it's 2021. I'm going to end there because that's when I go through all these not busy time. Then because the accounting goes on the 12-month period, so that means my beginning of the year should be what, my dear? April, right? So I start from April 1st, 2020. If I do my accounting this way, I made a lot of money in the beginning. I spent a lot of money in this lower time. My taxable income is more reflected on my real business. Am I right? So I'm not ending up paying taxes in December, which I just got through my busy time. I haven't really spent. So this is where when you start a grocery store, you want to ask yourself that question. Like I said, most of the grocery store, when you sell things year round, January to December, it's okay. It's great because that matches to your 1040 is easy to manage. But if you have a specialty store, you should think differently. So that's my number 2. In my 3D 3D tax planning consideration. You know, I wrote articles about that, and it is actually in my book as well. And it is something that I try to get into something simple. 3D just means three-dimensional, which I always, for my student, I always draw a box for them, saying that a lot of times when you do tax planning, your tax person will say, go buy a car, you know, go buy a house or something. You have to spend money in order to save money. So in my way of thinking about taxes is not like that. And we look at accounting method, we look at fiscal year, then we look at what we call tax structure. So those are the key things that I look at to save taxes. So it's a three-dimensional thought rather than just something, you know, you spend money so you can pay less taxes. That is so old, so need to retire. That thinking need to be gone. And then look at President Donald Trump. If his tax planning can be paying $750 in 10 years time, I don't think he spent all his money. And I think he had a strategy in place to take advantage of the tax system. As long as he's not being charged fraudulent, I consider he is brilliant. He knows how to save taxes, right? So I know you agree with me too, because we're not here to judge anybody. We don't know. And I mean, politics is very dark, so I don't go there. Um, so that's where we talked about 1 and 2. I know that make you think. Let me talk about tax structure right here, right now. Okay. And let me save that for you just in case you ask me for my slides. So I have it for you. And I'm going to clean my board so I can start doing the structure. So we are already 1 minute over. Just really quickly on the tax structure, you need to know that. So different structure offer you a different tax rate. The only really reason we care about the tax rate is because that we want to pay less taxes properly. Okay. So if you are a sole proprietor and or if you are a LLC active member and your rate for income tax is income tax rate plus self-employment tax rate. So if we assume our income tax rate is 20%, self-employment tax is always 15. So here you go, you have 35% of rate to pay taxes. But if you are a S Corp and your rate is only 20% because it's equals to whatever the income tax rate you're paying under the other tax structure, okay? So then your rate at the end is 20%. This is where a lot of businesses are under S Corp. S Corp has its own drawbacks, but from the tax rate standpoint, just to simplify it to the bottom line, they save your taxes, okay? Then the other structure is C Corp. And the C Corp has a flat rate of 21%. So that's 21. So here you may say, oh yes, S Corp is the best. No, because S Corp is a personal income tax rate. That rate goes from 0% all the way to God knows 31, 39.5, and with your other investment rate. And so there's other small rates coming in. So your rate is a lot. Take that as a 40. So if you are at a high rate level, and this is looking very attractive, okay? So it is really about you plan your structure. So I am not going to be able to tell you what you're going to be, but I can tell you this is your number 3 in my 3D tax planning thing, right? So remember in the other slide, we talked about number 1 is accounting method, and number 2 is the fiscal year consideration. Number 3 is your tax structure. So when you consider this 3, and you are really home with your tax planning. Tax planning is not about how to spend more money. Tax planning is about putting your business in the right place where you can ride with the wave and do things right but save taxes. Okay? So, I actually today we covered two big things. Number one is related to 2020 specific. We talked about PPP, EIDL loan. We talked about NOL carry forward, backward, and that was our first slides we were talking about. And then number two, we talk about general tax planning things you should always consider. And one is accounting method, and one is the fiscal year. The other one is your tax structure. I know I did promise you that we're going to go to take a look at where you know your accounting method is. So I'm going to stop sharing right here. And I am going back to my other screen to show you where that is. So you are now looking at my YouTube, right? I want to point to you where you can see the accounting method. So if you are a partnership tax return, the accounting method is right here, folks. Did you see that? Accounting method, cash, accrual, and other. And I talk about cash, how bad that is for the grocery store. And I talk about accrual should be the method that goes forward, right? And the 1120S is the S corporation. And the places you find there is on the second page where you see accounting method, there's a cash, accrual. All right. So these are, let's say if you already are on cash and you're wondering whether you can change to accrual method, and that really need a little bit of consideration of how your business is. So it's not a yes or no answer immediately. You really need to consult community CPA, and you can definitely reach out to our firm to help you to decide. But what I give you is general. It is so general, is 99% is true. Okay, so you want to look at where you are and really knowing as a grocery store, you have so much to plan. I mean, saving taxes is not even small saving. $100, and in average we pay 28%. $100 you can save $28. I mean, you would save coupons to go to grocery store to buy food, right? And you save less than 28%. You save a lot less, but you would go to the extent to use coupons to do that. Why are you not spending money and the time to do a better tax planning? So we are doing that, and I really want that. I know how some of you are new, so I really like to see you tap into the knowledge. And even if you don't come to community CPA, we have a channel to teach you. You can do that yourself, or you can bring our knowledge to the tax preparer that you trust and have them look into that for you. And one other thing I did not mention, I really need to mention to you, is spoilage write down. Okay. And every business is different. If you go on Google checking on spoilage write down, they tell you 2%. But you can establish your own. Did you hear me? You can establish your own spoilage write down and save that for your business. So when IRS audit you, what they do is they want to know why you write down so much. So you can establish that method. Tell IRS that this is what you did. You tracked in the season and how much you purchased, how much you sold, how much you throw away. That throw away, you need to know the percentage. Then we can actually give to the IRS. That will become your spoilage write down. It's customized. It's not 2%. Every grocery store I know is more than 2%. So don't go by Google search and go by your own business method. I will talk to you again. I apologize again for technical difficulty, but the content is absolutely very useful. And just keep in mind, you always have us to take care of you. Okay, talk to you. Bye.